Everybody, this is Dan Sheridan, and I'm going to walk you through a new trade I have put on here, a double long diagonal. This may be a first for a lot of you. I'm going to do three things today. I'm going to show you why I'm going to do this double long diagonal. Step one, back test it. Step two, I'm going to look at it in the modeling graph here. I'm going to look at it and we're going to talk about it. We're going to talk about the Greek, see what it looks like. What are we hoping for? And then number three, as long as we pass steps number one, it back tests well, it looks good in the model, we're going to automate it. And I actually automated this trade today. It's the first time I did one. And this is one of the days that you'll see in the back testing I did it. So that's what I'm going to do today. Hopefully it'll be a help to you. Again, I'm going to back test. This first thing you do, back test an idea, see if it works. Number two, look at it in the graph. What does it look like? What am I rooting for? What am I not rooting for? And number three, if you like it, boom, I can automate the trade. So let's start out here. First step is back test. Here's the back test. You say, Dan, what is this? It's called a double long diagonal. A lot of times I'll call it an inside diagonal. So let's explain. The dates I'm looking at SPX over a 3-year period where we're using dailies. And I'm going to do I'm going to sell a 25 delta put. I'm going to sell a 20 delta call. And I'm going to buy my longs 5 points further out of the money. So it's going to lean a little bit long delta. Why would that be? I'm selling a higher delta put, 25 delta, and I'm selling a 20 delta call. My shorts are going to be 11 days from expiration. My longs will be 15 days from expiration. Is this a diagonal type trade? Yeah, what's a diagonal trade? A mixed month with different strikes, right? Double calendar would be mixed month, same strikes. This will be a debit transaction. I'm going to open trades at 2:59 p.m. every Monday and Thursday. Today's Thursday, so I put one on at about 2:59 p.m. Eastern. Right now we're at 3:20, so I'll show you the exact trade. I'll use exact strike offsets, allocate 10% of portfolio. I just did one contract. I don't want a VIX higher than 25, right? This is technically still a range-bound trade, so if VIX goes over 25, all bedlam's breaking loose, right? And it could move pretty far away. So I want to control, by keeping the VIX under 25, a relatively, it's not going to be like a COVID correction where we move 800 points. We'll be out before then. Profit target 50%. Exit trades at 3:40 Eastern. An expiration day. Again, our shorts are 11 days out. Our longs are 15 days out. Put it every Monday and Thursday. So on Thursday, you count 11, including the weekend. So it'd be Friday, Saturday, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday. So if you do it on Thursday, you're going to sell a Monday, and then you're going to buy your long 4 days further out, Friday. So again, on a Thursday, I'm going to sell 11 days out. That includes the weekend. So I'd sell a Monday, buy a Friday. And then these are miscellaneous, opening fees, closing fees. It includes slippage, cap profits. I'm going to get out where I say I'm going to get out, and require two prices of profit target. So, you want this as realistic as possible. You want to include commissions. You want to include that it doesn't hit a 50% or whatever profit target just one time, which you see a lot of times. And I want a decent premium. So this is the minimum short-long ratio 0.55. I want there to be some juice in there. So back tested this, and we have, you can see it, won 60% of the time, starting capital, ending capital in the back testing, MAR ratio 4.6, a win percentage 59, and there's a good sample size of trades. So 197 trades. You don't want something with like 4 trades. So that's the test. And if you look down here, look at the trade log, this could be generally maybe a $14 to $25 trade, depending on where volatilities are. And you could see here, again, I used in this example of back testing 10% of the portfolio. So you can see some bigger numbers here, but you can see the profit targets. You have some losers here. some of the reasons for getting out of the trade. You can see profit target. You also have exit when the short long ratio is below 0.15, exit using leg delta. So if you just to get a little more color here, you can see this is the actual back test. So you can see as we go through these, I'm selling a 25 delta put, 20 delta call. My longs are 5 points away. In the paper, in the back testing here, 100,000 funds, margin 10%, entry time 2:59 Eastern, put it on Monday and Thursday using VIX. I want a maximum of 25 VIX. And as you go down, profit target 50%, use early exit. On the day of expiration, get out at 3:40 Eastern. But we call these rails or risk management. When would I want to get out? When would I cry uncle? If you take the short put, again, we're selling a put of 25 delta, 11 days out. When that 25 delta hits 65, that means it's getting in the money too much. Get me out, right? So there's a rail. This isn't just, I hope it works out, right? On the upside, your short call, you're selling at 20. When the delta of the short call goes from 20 to 70, remember Roberto Duran and Sugar Ray Leonard? No mas, I'm out. These are great risk management tools. And it's basically saying in this double type structure, you go too far past the short strikes. It's like going outside the buoys when you're in a lake and the lifeguard says, where are you going, my friend, right? Use short long ratio. You want some juice in it. It's saying exit when short long ratio is below 0.15. What does that mean? There's no juice left. What are you doing? You're basically just long that strangle, right? Then you got all types of volatility risk. Here's some commissions, slippage, require 2 consecutive hits at profit target. You want, realistic back testing. And you want a minimum short long ratio to enter a 0.55. You want some juice. And if that gets too low, get me out. So that's the back test. All right. Looks like it's working. Back test is fine. Now we go to the modeling. And we look at this. And really, when you look at this, I'm playing this to give myself plenty of room, right? So you could look at, in this example, here's what I'm doing. I'm selling the 68.55 call, and I'm selling the 66.20 put. So, and I'll talk about this in a second. Am I giving up some room in the middle to get myself more room in the sides? Yes. Again, this is 11 days for the shorts. So you can see here, I'm selling the 68.55 calls. Now watch this. Where am I buying my call? Inside my short, 68.50, 5 points before my short call. It's an inside diagonal. I'm selling the 66.20 put. Remember, that's at a 25 delta. Where am I buying my long? 5 points before it, inside 66.25. A double diagonal, you're buying your longs more out of the money. A double long diagonal, you're buying them a little inside. So again, I'm selling the 68.55s. I'm buying the 68.50s inside my short. I'm selling the 66.20 puts. I'm buying my puts a little bit inside, kind of closer to the middle of the graph. When would I do this type of trade? When I'm over like a double calendar or a double diagonal. This is a little better for a move, right? You're buying more extrinsic value. You have a little more volatility risk, but your game plan is either the volatility goes up or you get in these wing areas of the graph. And why do you want the volatility to go up? Let's look at the graphs, the Greeks. We're starting out 3 deltas long, pretty flat gamma, positive theta trade, long Vega. This is row Vanna, it's not Vanna White, and charm. What else we have here? Current price, max loss, max profit, and then I'm going to go over these in a second. But if we look at this trade, first let's just start with, here's the date here. This is neat. So if I just go slowly, you can see this here as I move here, Friday, October 24th. right? We started this 11 days till expiration. Now we're 10 days. Watch this. Keep moving it 9 days. 8 days in the trade, right? So the more time that we're in the trade, right, what do you think is going to happen? As we get closer to expiration, something interesting happens. As you get closer to expiration, the sun rises. Where is the sun rising? The green, the profitable area. As we go close to expiration, if we get in the profitable area, these wings, it's happy days are here again, right? That's what you want as you get close to expiration. Now, let's bring that back. Let's look at the volatility. This is the volatility, applied volatility when we start 13.68. Here's the volatility of each of the options starting out. The long of 15 days out is 13.88. The short is 13.47. You can see, remember, VIX going up, VIX does not represent the 4 options here, right? So you need to be aware of what are the volatilities of each of them. Sometimes the long can go up, right? You can see if the long goes up just a little bit, look at that. The sun is rising, right? Isn't that a song, The Rising of the Sun? But that because the volatility, this is long Vega. Remember that we talked about the long Vega. So as the volatility goes up even a little bit, you can see this thing kicks in. And particularly what I like about this is, when we're starting out, I look at these volatilities and I say 13 for the long, right? On a day like today, the VIX dropped quite a bit. So we're around maybe 17 in the VIX. But you can see VIX 17 doesn't mean my individual options are going to be 17, right? So this is the volatility, implied volatility of the 11-day, implied volatility of the 15-day. Sometimes you're short. If we get a big move in the market, your short could maybe move more than your long, right? So it all depends how these things move in concert, but you could see we want the volatility to go up. And then here's another thing. When you're looking at this, here's the Greeks, here's the P&L, but what if we want to look at some of these individually? Let's look at P&L and let's look at delta. So this is the graph of delta. As you start out, as we go up, right? You're starting out long deltas, but this is a short gamma trade. So eventually these deltas get shorter on the way up because you're short gamma. And as you go down, you can see your deltas are going to get longer on the way down, right? And your P&L, right, as we go down, you'll lose on a big move if we go too far. Same with the upside, right? Now, I'm just going to keep these. You can look at many of these together. I'm just going to look at them separate and just pick a couple. Here's theta, right? So you can see here's the theta. And as we go towards the short strikes, your theta would go up, different things. And you can do this over, we can move it. If you move this, obviously, if we go closer towards expiration and you go in the middle here, theta in the middle would be more negative if we're in the middle of the graph as time passes. But as we get towards the wings, that theta would increase. This is 4 days from expiration. So how about if you look at Vega? So I'm just isolating one Greek with the P&L. Here's Vega. As you start the trade, your Vega is 294. At the beginning, your Vega is 210. As you go further into the trade, your Vega is actually going to go up, right? Because a lot of your juice is going to come out of this. So you're basically going to be long. There's going to be, it's more your long options, which are 15 days out. We're going to look like that, right? You're going to have more extrinsic value. You've brought in a lot of the premium of your short. So you can play with these. I think a lot of people are visual learners. I am too. You can go through all of these. And so this is just neat. You can play with this till your heart's content, right? Let me just put this back here. Anyways, so once we get, right? Once we look at the graph, we get a feel of where it does well, where it does not, right? And a lot of this is volatility, right? Because again, let's face the facts here. If volatility starts going up, right? That's what you want. And again, I don't mind the sag in the middle. You say, Dan, give me 2 reasons you don't mind the sag in the middle. Because we've got 11 days till expiration. And if we move, right? If we move, I want it to move into the wings, right? We've got plenty of time. So I'm not concerned about the middle right now, especially our vols are kind of low. 17, we've dropped a lot lately, about 11 points in volatility in less than a week. So this sag doesn't bother me for those reasons. All right, I go through the test, back testing, looks good. I'm happy with it. I look at the modeling, that helps me understand it, get a better feel of it. And then what's the last thing that we do? Last thing we do is put the trade on. And you can see I put this on today, Thursday, Oct 23 at 259. I put on the trade. This is the first one, 11.15 double long diagonal. Initial premium, $22.35. Scroll this down here. And then you could see exactly here what strikes I sold, what strikes I bought. This is the debit. So it's been on for, less than an hour. It gives you the opening price of SPX. This is what I paid for it and all of that. So just want to give you a little feel. I mean, what I like about it is it all goes together. You got the whole kabacle, right? What did I do? You back test it. You model, you look at it. If you like it, I automate the trade, right? And you stick with you stick with your plan. So folks, I hope that helped you a bit. Have a nice day, and I'll talk to you next time. Thanks so much.